IVE's 124-day recovery crushed VT's 474 days. When speed matters, faster rebounds often trump broader diversification. IVE bounced back in just 4 months. VT, nearly 16 months underwater. That's a year of waiting and wondering. IVE's 80% 5-year return crushed global diversification by 10 points. U.S. value concentration delivered the commanding win. VT's 38% international exposure cost it dearly, returning just 70% while U.S. markets absolutely dominated these 5 years. IVE won the race by 10% over 5 years, staying purely U.S. VT took the global scenic route and lagged behind significantly. Over 3 years, VT's global reach delivered 67% returns, beating IVE's 52% U.S. value approach decisively. VT's 23% crushed IVE's 15% this year. That's an 8-point win for global diversification over U.S. value alone. VT's higher Sharpe ratio means you're getting better returns for every unit of risk you're taking here. VT's 1.4 Sortino beats IVE's 1.2, meaning better returns with less downside pain when markets actually drop. Think of it like a report card. VT earns better grades by scoring solid returns with fewer penalties, while IVE performs well but takes bigger hits. Volatility is nearly identical here. IVE at 13%, VT at 14%, so you're getting basically the same ride smoothness either way. IVE's 18% maximum drawdown shows impressive resilience. U.S. value stocks protected capital when markets crashed hard. VT's 26% crash proved diversification fails when global markets tanked together. International exposure magnified the pain instead. Both funds shake you around with similar volatility, about 13 to 14%. But VT's roller coaster drops 8 points deeper when markets crash. IVE's recovery speed is impressive. Just 124 days to bounce back from its worst drawdown. IVE's 80% 5-year win looks impressive, but VT's superior risk-adjusted returns and recent momentum tell a more compelling story despite those deeper drawdowns. VT took 474 days to recover, over 15 months watching your money sit underwater while global markets slowly healed. VT's 0.06% fee versus IVE's 0.18% means you're paying triple for less diversification. That's hard to justify. VT's 0.06% fee versus IVE's 0.18%, that 0.12% gap quietly compounds into real wealth over decades. IVE's 18 cents per 100 versus VT's 6 cents sounds tiny, but that's couch change that snowballs into thousands over decades of compounding. IVE's 1% international allocation is an all-in bet on American value stocks that paid off handsomely here. VT gives you 38% international exposure, real global diversification across Europe, Asia-Pacific, and emerging markets worldwide. VT's 26% tech weighting beats IVE's 18%, giving it an 8-point edge to capture innovation-driven gains. IVE doubles down on energy at 7% versus VT's 3.7%, boosting commodity rallies but cranking up volatility. VT loads up on tech stocks while IVE favors energy. It's like ordering different pizza slices. Each sector gives you totally different flavors of returns. IVE crushed it over 5 years with 80% returns, while VT dominated recently with better risk metrics. IVE's faster recovery suits shorter timelines, while VT's global reach and lower fees shine over decades. IVEs built for speed on US markets, while VTs your global all-rounder with lower costs. Different race cars for different tracks, really. Standard legal disclaimer. Do your research, consult professionals, and invest at your own risk. Want more fun battles with real data? Subscribe for weekly ETF comparisons that actually show you which funds win.